What is going on, guys? What is going on? What is going on? Good afternoon, ladies and gentlemen. Hope everybody's all right. What's going on, guys? Is this too loud, or can should be all right, right? That should do it right there. You only join the stream to hear the dumb questions, like the guy who's like, moon, like that, because it's the same every single FOMC, up or down. All indicators pointing dovish. Yeah, well, I mean, this article came out this morning talking about the fact that the Fed might consider pausing the balance sheet runoff. So obviously they're not going to cut rates today. I think everybody and their mom knows that. If they do cut rates today, it'll be the biggest rate surprise in, I don't know, decades. So they're not going to cut rates today. But this is what everyone will be waiting on to hear. Whether... Apply. What the fuck?
Welcome back. We're about half an hour away from the Fed.
Whether they pause their balance sheet runoff, which would essentially create more liquidity, which would be bullish. But if you guys have been following my videos, you know that, you know, my expectation was this right here is the correction, the official minus 10% correction sitting at the 300-day moving average, right? And that we would see a rally, a short-term rally before potential further downturn. Now, if the Fed says that they're going to pause their balance sheet runoff, then we could see more of a rally in the coming days. But I really hope that you guys limit your questions. Most of you know what's up, but there are quite a few people that join these streams, and every 2 seconds I'm going to get someone named Krishna Kumar saying up or down, gold short or long, please tell me, short, long. And the fact of the matter, well, there are going to be those questions, and then the other set of questions are going to be, why is the market doing X? Why is the market going up? Why is the market going down? Right? And obviously it's FOMC. You're going to see both. You're going to see price move in both directions. We're going to get stops in both directions, right? Days like this are an absolute dream for market makers because there's just going to be stops taken in both directions. So I would really appreciate if you guys tone down. Like I said, most of you are cool, but a lot of people do end up joining these FOMC streams. So I would really appreciate if you guys tone down the, why is the market doing this? Or tell me, gold long or short? USD, CAD, long or short? Moon or tank? Shut off the chat? If you guys want me to, I'll shut off the chat. But then I won't be able to pinpoint who's clowning me and who's about to get a clap back. Who's about to get a mom clap back. So if you guys want me to turn off the chat, I'll be more than happy to do that. But I think it will limit your entertainment value. So you recommend to watch FOMC and don't bet before it starts, right? I recommend that if you're asking that question, you not trade with real money. That's what I recommend. Is Meta a buy right now? I sent out my Meta analysis in the Discord yesterday, but basically, Meta's valuation currently is not as cheap as some other stocks. So some other stocks that I went heavier on, i.e. Nvidia, Google, even Amazon, is cheaper relative to how it normally trades in the last at least 5 years than Meta. Meta is fairly valued right now. Is it cheap? No. Is it expensive? No. Meta is right now at a fair value. But there are other stocks that are actually cheap. I want to consider taking a long here before FOMC. React to FOMC, don't try to predict. Yeah, I mean, you shouldn't be. You're going to get a move after the release is dropped, and then you're going to get a move when Powell's talking, and then you're going to get another move when Powell's done. So yeah, I mean, if you're not adept at reading liquidity, you definitely shouldn't be trading today. But for sure, you shouldn't be holding a position past 2 p.m. So trading before 2 p.m., if you can read the moves and you have a good risk to reward, perfectly fine. After 2 p.m., you're going to get craziness for a few minutes. And then Powell's going to talk at 2:30. And there's going to be an initial move when Powell talks, during Powell's talks. During Powell's speech. Why the fuck can I talk? During Powell's speech, and then you're going to get a move after he's done. So, yes, your goal is to, if you're day trading, to try to react to that. But if you think that whatever moves happen today is going to dictate the moves for the two weeks to come, you're absolutely mistaken. Today can absolutely tank, and we can rally for the next 2 weeks, and vice versa. So this is why I'm saying, please reserve the annoying, why is the market doing this? I thought it was bearish. It's all just manipulation, right? If you don't know by now that the market can move up on can move up on bad news and move down on good news, can move up on good news and move down on bad news, it really doesn't matter. It just depends on where the liquidity is. Where's the most liquidity? That's all the market is trying to do, to extract liquidity. What's your opinion on AMD touching the negative trend line? Yeah, I think there might be a short on AMD coming up. Serrano, thank you for your donation, bro. Appreciate you always donating, dude. Whether we take a trade and you end up with a win, or we haven't even taken a trade yet, you're always donating. I appreciate it, man. What I'm really looking at here on either index, we hit the 4-hour fair value gap on both, right? Both ES and NQ. And we won't have a new 4-hour candle until 2 p.m. So ironically, when the Fed decision is dropped in 20 minutes, we'll get another 4-hour candle. This right here typically is bearish, right? What I was waiting on even yesterday, these equal lows, I want these to be taken. Whether they're taken today or not is anybody's guess. But if those equal lows are taken, that could set up a multi-day long on the S&P 500. But weirdly enough, these are the same equal lows that you see on NQ. So that's ES and that's NQ. And they're both in a 4-hour fair value gap. So I want to see these lows swept before any move up in the coming days. Your take on coin. What kind of take, bro? My take is that you should ask more specific questions so that I don't just blabber on about Coinbase and hope to answer your question. AMD's GPUs are now outperforming and outselling NVIDIA's. Bro, I didn't know that they gave out free crack at the Whole Foods nowadays. Really, that's amazing to know that they're supplying people with free drugs, and apparently people are taking them and then trying to make stock market analysis. This dude said that AMD GPUs are outselling NVIDIA. Like, I don't know. I've never done crack, so I don't know if it's strong enough to create such delusions. Maybe it needs to be mixed with something. But apparently they're giving it out for free because this guy's claiming that AMD is outselling NVIDIA. As if we don't have fucking access to balance sheets here. As if we don't have access to income statements. As if you can't literally just pull this up and either in ChatGPT or Grok and ask it a specific question. But it's as if we don't see that NVIDIA is pulling in $130 billion of revenue for the year. And AMD is pulling in $25 billion of revenue. As if we can't see that. Yeah, bro. Outselling NVIDIA. You're right. Bro said a fact and got a whole yap session. Can't believe you guys are donating to this fool. I can't believe you're that much of an idiot to think someone is donating to me. It clearly says St. Jude on the donate button. My name is not St. Jude. It's a hospital. All right. An actual trading question. When going long on a put, do you limit the purchase price based on the strike price? For example, if the strike price is 320, is 27.50 too much for the contract? That's not how options work. I appreciate the question. There's nothing called too much based on the absolute price. You have to look at the IV and you have to look at the relative IV. So when you're looking at the relative IV of an option, so say for instance that I'm looking at, here, I'll pull up something easy. Let's pull up something like Carvana, right? Or actually, wait, let me see if I can find a better example for you. Maybe MicroStrategy. Okay. So when you pull up options data, right, in Thinkorswim, you'll see it here, but you can Google it for any stock if you don't have access to Thinkorswim. But you can see here that it says the current IV percentile is 17%, right? For MicroStrategy options. That means that 83% of the time, MicroStrategy's IV is higher. So relative to MicroStrategy, right now, options are trading at low IV. When options are trading at high relative IV, that means that they are more expensive. So this is why you'll get stocks that have a similar price, but can have wildly different options prices because of IV as well as demand for the option will affect an options price, right? So an options price is not expensive or cheap relative to its stock price. I hope that makes sense. I hope that explanation made sense. You can, if you just type in ChatGPT, right, how are options priced, you can go down the rabbit hole about Black-Scholes model, which is how options are priced in today's market, using the Black-Scholes model. And you can see what goes into an options price. But what I explained was the long and short of it. 15 minutes to the Fed decision. Correct. Fifteen minutes. Edward Locke. Your stock analysis has gone from dealing with stock charts to analyzing people's stupidness. You should take a vacation. You sound very distracted. One, I don't go live that often on YouTube. I do this for you guys. FOMC, CPI, etc. Two, it's entertainment. So yes, stock analysis and entertainment. Three, I'm waiting for the Fed decision in 13 minutes. So not much is happening now. And four, you don't need to announce that you're signing off. I don't know who you are. So you're ascribing a level of importance to yourself that I don't think is dealing in reality. But feel free, bro. The stream is open. You can come and go as you please. No, I don't think they're. Oh, sorry. I thought you meant cut. Yes, I think they're going to pause, meaning they've already paused, but I think they're going to hold further, if that's what you're asking. Yeah, I think they're going to hold rates. I don't think they're going to cut. If they cut, it'll be the biggest surprise in Fed history, and I think the market will not know how to deal with that. But I think when we hear Powell, here's what I think. When we hear Powell, I think what he's going to say is we can't he's going to say inflation is moving in the right direction. Unemployment isn't too bad, yada, yada, yada. But then he will eventually, I think, he'll try to blame Trump. And I think he'll say that we don't yet know the potential inflationary effects of the tariffs. And so we cannot prematurely cut because we don't know what the policy is yet. And I guarantee you he's going to say something like that. He might not be that straightforward. He might. He has before, right? When they've asked him, if Trump asks you to step down, are you going to say yes? And he said no. Or, I don't know, hell no, or something like that. But I think that he will point to the unknown, ever-changing tariff policy and claim that that's the reason why they're not going to cut today, because they don't know if those tariffs are going to be in place, and if they are, what inflationary pressures that they'll put on prices, right? So, But I do think they're going to hold. I don't know how early or late you joined the stream, but what I said was this article from Nick Timiraos, who's probably my favorite Wall Street Journal, actually the only person at Wall Street Journal that I read. I really like his analysis. I also follow him on X. But he's probably the most informed finance reporter as it relates to Fed and Fed policy. He's been covering the Fed for a very long time. So when he writes something, I definitely read it. And his reporting is saying that the Fed might consider pausing their balance sheet runoff. So what this means here, let me see if I can visually, for those that don't watch all of my videos, which is perfectly fine. Here's the Fed's balance sheet, okay? So the Fed, and we have 9 minutes until the Fed release, so we're not going to miss it. But the Fed buys treasuries and puts it on their balance sheet, right? That's how you get anonymous. Whoever that was, appreciate your donation to St. Jude. Thank you so much for the $50 donation. Appreciate it. One second. So the Fed buys treasuries and puts them on their balance sheet. The reason they do this is they want to improve liquidity, not only in the treasury market, right? If there's a bunch of treasuries that no one's buying, that's when yields go up. But they also do it to provide the banks with liquidity. So when they buy treasuries, they're buying it from the banks. And so that money ends up in the banks, and the banks will then be able to lend that money out cheaply, right? So when we talk about money printing, I think a lot of people think that they just print money and hand it out. That's not really the case. It's working with the Fed and the Treasury. So the Fed will actually print money, not actual paper money. They'll just enter it into the computer, and they'll say, okay, let's just say Bank of America, you get, $200 billion. Give us $200 billion of treasuries. And an additional $200 billion appears out of nowhere to the banks. And then the Bank of America can then say, okay, you want a house, you want a car, you want money for your business. And that's how the money makes its way into the economy, right? That's when we talk about money printing. So this spike here was an additional $5 trillion that was printed during COVID. So in order to fight inflation, the Fed now is not buying treasuries anymore. And moreover, they're selling treasuries or letting those treasuries expire, right? So this is called quantitative tightening. Quantitative easing is when they buy treasuries again. So what Nick Timiraos is saying is that the Fed could pause their quantitative tightening. So the measures that they're taking in order to curb inflation and remove liquidity from the economy, that they could put a stop to this. So right now we want to hear Powell at 2:30 speak his opinion on that, right? Because if he says we're pausing our balance sheet runoff, that will be short-term bullish to the market. And don't please, again, the comments, oh, why is the market doing this? Today's FOMC day, right? The market's going to do this, just like it's been doing, taking out stops. So whatever the Fed decides will likely not be fully reflected in today's price action. I'm talking about the next few weeks. So, please reserve the why is the market doing this questions, regardless of what the Fed decision is. Do not take today at face value. Today, you're just trying to, if we get trades in, we're just trying to day trade the price action, right? Irrespective of the Fed policy, okay? But I'm talking about for weeks to come. So that's what we want to see. I don't think the Fed is going to cut, and I think all ears will be tuned in to hear what their opinion is on this. you're forgetting the adjustment for GDP and bond yields regarding the USD. I apologize, Hyper Sniper. I have no idea what you mean. Bond yields regarding the USD. Maybe if you try to explain it a bit better. But yeah, I'll try to answer your question or comment on it if I get it. Great explanation. Thank you. Hope that helped. Still think it's dovish for now. This would definitely be dovish. Yeah. In your opinion, is it possible for the U.S. market to experience a recession without seeing TLT price rise? Yes, but when in a recession and then the Fed policy is to slam rates to the ground, then you will see bonds eventually affected. But yes, can we enter a recession while bond yields are up? Yeah, as a matter of fact, most of the recessions we enter happen while treasury rates are up, which is part of the reason why we enter a recession. Yeah. Before 2:30, isn't IV up and hence selling options, call or put profitable? Not necessarily. Yes, IV is up. Whether you're profitable or not depends on how stupid or smart your trade is. So yeah, if you're looking to sell options, like say, what is a stock that's currently, Tesla had a big day today. The time to sell puts would have been yesterday. But say you want to sell calls on Tesla. We just closed out our cover calls yesterday for 70%, right? But say that you want to sell calls to protect your recently bought shares. Let's say you bought Tesla at 220 and Tesla is having a 4% day and you want to protect your shares. You can sell like the 275 or the 300 call right now. So in that regard, yes. But if you're trying to trade, SPY or QQQ and sell options very close to the money, whether you're profitable or not depends on what the hell it is you're doing. So, yeah. But like right now, if you look at Tesla right now, because of its up day, right? I might actually do this because we just closed out our cover calls. But if you wanted to, if you bought shares recently and you wanted to sell, say the 275 calls, you could sell for $535 against your shares. Yes, you would experience a bump from the IV crush that happens in a few minutes, but it's not going to be that big of a bump. So All right. 1 minute until the Fed decision. I'm going to turn this up and I'm going to look at price action because I want to see if there's a trade that I would take here.
Noted a slowing job market, but we haven't heard that in the last couple of meetings, so that's a little bit weird. And then what do you make of the bond market's move? Borrowing costs have actually gone up by over 0.5% since the Fed cut rates on September 18th.
Yeah, so I think the initial conditions matter a lot, right? So when we started the year, we thought there were going to be 3 or 4 rate cuts this year. Jobs market would get weaker, and we really hadn't seen that. So I think we had a really strong fourth quarter. That boosted interest rates higher. That kept the jobs market really strong. But the important point here, Brian, is all of that is starting to fade right now. And it's a question of, does that continue? And that's what we're going to try to find out.
Well, we're going to find out here in about 10 seconds because that's when the Fed decision is coming out again. No change expected, but it's what they say. And we'll give you the rundown. Kelly gave it to you just at the top of the show. We are seeing markets that are higher, at least for now. Maybe not Microsoft, but the Dow is up about 0.25%. The NASDAQ, the big winner, 0.7%, and a 10-year bond yield at 4.3%. Let's go right now to Steve Leisman in D.C.
the Federal Reserve keeping interest rates unchanged at 4.25% to 4.5%. But it makes a point of saying that uncertainty around the economic outlook has increased, and the Fed says it is attentive to risks on both sides of its mandate. In a move that we will be debating, it removed the statement saying that risks to its dual mandate are roughly in balance. That came out of the statement this time. On the Fed's projections, it boosted core inflation to 2.8% for 2025 from 2.5%, so 0.3 up. By the way, exactly mirroring the CNBC Fed survey. It kept 2026 at 2.2, and same for 2027 at 2%, suggesting the Fed either thinks it will control inflation through its policy or that any tariff issues will pass through. It did reduce its growth forecast all the way down to 1.7 for this year from 2.1%. And by 0.2% in 2026. So the Fed does see a weakening impulse coming to economic growth. However, in answer to the discussion you were just having, it really kept the unemployment outlook very much unchanged. Only a 10th increase in the unemployment forecast. So now you're wondering what they do with rates. They kept the 2 rate cuts in place for 2025, but the dot plot is a touch more hawkish, and I will go over that in just a second. I want to tell you the news on the balance sheet, for which there is some. They reduced the runoff of treasuries down to $5 billion monthly from $25 billion. They kept the mortgage-backed security runoff at $35 billion. Governor Waller, he dissented, very technical dissent actually. He agreed with the idea of not to change rates, but he did not want to change or reduce the balance sheet runoff. On the economy, they say it's expanding at a solid pace. They say unemployment has stabilized, but inflation remains somewhat elevated. Now, let me give you the hawkish tilt inside this dot plot here. 4 of the 19 officials wanted no rate cuts, compared to only 1 in the December forecast. 4 see only 1 cuts, and 9 see 2 cuts. What's gone is the kind of, I don't know what you'd call it, the dovish wing of the committee here, where there were 5 people who were looking for 75 basis points of cuts this year. Now there are only 2. So a kind of compression here, leaving the top where it was and some of the bottom coming up, a little bit more hawkish here, but the median still maintaining a forecast or an outlook, not a promise, but an outlook for 2 rate cuts this year. Guys, back to you.
So, Steve, you know, I can't say, look, the market is interpreting this in a somewhat dovish manner. And for me, I'm going right to the balance sheet on this. This is super interesting. And I want to make sure that I kind of explain this clearly and that I understand it clearly. So in essence, the Federal Reserve just decided it's going to sell fewer Treasury bonds, right, from its balance sheet. As it's deciding.
Can I grammatically correct you, Kelly?
Well, yes, I'm oversimplifying.
Only for technical reasons. I don't want to be rude here.
Yeah.
But I do want to say the technical thing is the Fed will allow fewer treasuries to run off of its balance sheet. That is, to run off, mature, and not be replaced. They're not selling. If they were selling, the market would be freaking. But they're letting it run off, so the market's not freaking. Sorry for the interruption.
Well, I guess point being, and maybe one of our guests can step in. David Kelly, I'd be curious for your reaction on this, but if the Fed is slowing the runoff, on the margin, that's why I'm looking at bond yields falling right now. Is this welcome news for a Treasury market where every little bit that helps in terms of people keeping the treasuries that they have and not reducing their balance sheet more, as the Fed's doing here, does that really help on the margin with interest rates as we watch the 10-year moving to the downside?
Well, very marginally. This actually wasn't unexpected. The problem, they've got some multiple areas of uncertainty here, and one of them has to do with the debt ceiling. So they think there's going to be a debt ceiling agreement at some stage over the summer. When that happens, the Treasury is going to bounce up or increase its holdings of the Federal Reserve, which will cut reserves. It brings the idea of a problem in the Treasury market more, or in short-term interest rates more likely, and that's what they've been trying to avoid. They want to be sure that they don't have a repeat of what they had back in 2018, where they let reserves get down too low.
Yes.
Now they see a risk of that in the next few months, and that's why they are just backing off here. They just don't want to reduce that balance sheet too much and end up with a problem. So just trying to keep out of the way of trouble here in a very uncertain environment.
And David, I only want to harp on this because Steve just said there were some hawkish elements. So if people are wondering, well, why would that not translate to bond yields going up and so on and so forth? I mean, do you think that these moves on the balance sheet offset or mitigate that to some extent?
Maybe a little bit, but I think the truth is the economy, traders, consumers, businesses, we're all in wait-and-see mode here on what administration policies tend to turn out to be in the end on tariffs, on government cutbacks, on immigration, and on fiscal policy for 2026. I think the one thing I would sort of take issue with here is I actually think economic growth could be slower than 1.7% this year, fourth quarter over fourth quarter. We're seeing a good deal of weakness in the first quarter numbers, which isn't really reflected in their statement. So that's the one place I'd be a little bit different from the Fed on here. But I don't blame them for trying to be cautious here because they really have to wait to see what the other side of Washington does.
Yeah, and Steph, let's go back to this idea of the grammatical technical correction, right? The runoff, not the sell. And Steve, you jump in. But Steph, this seems to be maybe a bigger deal than the headlines might suggest. And I'm saying that because our friend Jeff Kilberg notes this is kind of a mini QE, quantitative easing injection. At least it appears that to him. Most of our viewers and listeners probably don't care that much about what the Federal Reserve does. They simply want their own borrowing costs, mortgage rates, auto rates, credit card rates, whatever it may be, to come down as well. How do you read this running off, not selling of treasuries?
Yeah, and that's been the case throughout, most of this QT period. Now they're just slowing down the pace of that, which makes sense, right? As David highlighted, there's concern around the debt ceiling that could create a lot of volatility within reserves. They're just trying to get ahead of it. This was a fairly modest move, and it was hinted in the minutes. So while this is slightly, a slight surprise, it was not overly surprising for the market, but this is the one difference versus what forecasters had effectively priced in, which was the change in growth, change in inflation, and expectation that they could stay pat on rates at this point because we don't really know the full effect of policy. April 2nd is going to be a really telling deadline in terms of what Trump's going to do from a tariff perspective.
Yeah, sorry, Jim. Let's go very quickly through just kind of the people are just joining us here. Oh, my gosh, the Federal Reserve, they jump in. Here's, I think, how we're reading this. And again, Steve Leisman, please jump in if any of this is not correct. By the way, markets there are not moving or moving slightly higher. Maybe on this news we shall see. The Fed sees the economy expanding. Maybe 2 rate cuts seen this year. No real change in the job market the rest of the year. Maybe a slight, I think Steve Leisman said 0.1% drop in the jobless rate so far this year. Inflation maybe mildly higher as well. So, Jim, how do you read what the Federal Reserve just did?
I think this is very non-committal. The Fed is kicking the tires on the economy. Look, we have a couple of things in front of us, and I think it's very important to respect the timeline. We've got reciprocal tariffs coming up on April 2nd. We don't really know how that's going to go, but it's in front of us. Then you have first quarter earnings results that are going to come out. CEOs are not going to sing a positive tune about the first quarter, right? You're likely to see some. Basically some bad news from some of the CEOs, or at least talking that way. The next Fed meeting is May 7th, and I think that tees us up for a rate cut at the June 18th Fed meeting. So essentially, this is the first time the Fed is trying to make a decision as financial conditions are tightening, meaning that credit spreads are widening and the equity market has just gone through a 10% drawdown. So effectively, this is the first time the Fed is trying to decide, as markets are now starting to soften and weaken, what they ought to do. And in the past, you had a stronger equity market, tight credit spreads, and the Fed was trying to convince you that cutting interest rates was the right thing to do. Now, the markets are kind of siding that way, but they're not 100% sure how this is all going to play out. April data, the events of April, I can't underscore this enough, are going to be extremely important, and I think the tone is going to be changed by May 7th at the next meeting.
Steve, we know that the market's first interpretation is often not its final one. Going back as we digest this, what kind of explain to us the hawkish element you see a little bit here in the statement and in the dots?
Okay, I'll go back to my notes here. It's a very technical thing. I wish I had a graphic I could put up. Maybe they have it up right there. Okay, so here's what happened. There's 4 now with no cuts for this year. That had been only, I want to double check what I'm saying here, had been only 2, okay? And then you see there's 2 with 3 cuts. There had been 5 with 3 cuts. So a compression towards the middle. Guys, I want to explain how maybe I look at this whole statement. I don't see the balance sheet as that big a deal. The bond market may get some help from that. To me, this is a bit like the Fed sending up a flare or an SOS and saying, we don't know what's going to happen. They reduced the growth rate pretty sharply. They raised the inflation rate pretty sharply and kept the outlook for rates pretty much unchanged. But more importantly to me is it removed that statement in the from the last statement that said, we think risks are roughly in balance. That's gone. I don't think they know where risks are going to go. And I think what they're doing, I think it was Jim who said it earlier, playing for time is where they're at right now because of the uncertainty. Look, they took this statement that said uncertainty has increased and put it up in like the second paragraph of the statement here. So this is almost waving a white flag on the outlook saying we surrender.
Well, I guess, and this is great stuff, and I threw both this statement, Kelly, and the last statement into ChatGPT because I wanted to see what it filtered out. And basically, Steve Leisman is ChatGPT because the two came to the exact same conclusion.
Sorry,
and Steve doesn't require nearly as much energy. David, Kelly, what's interesting about...
You don't know how much energy I require, Brian.
Well, today I know you might need a few extra caffeinated coffees. David, but here's the reality, and I think to waving the white flag point, April 2nd are when these new tariffs are supposed to kick in. They may not. They could kick in before. They could kick in never. They could kick in later. We don't know how much. I'm not saying this statement doesn't matter, but how much do you think the Federal Reserve is like everybody else, just kind of waiting and seeing what this administration does? Because how do they make any real policy moves when we don't actually know what's going to happen?
Exactly. 2 days after the election, Jay Powell said, we don't guess, we don't speculate, and we don't assume. But you can't make monetary policy unless you do one of those things. And so eventually it's going to have to make a monetary policy move one way or the other. But I think it's not just the tariffs. The other part of it that's really important is how does this how does the tax bill for 2026 evolve over the next month or two? If we get one big bill which involves a lot of fiscal stimulus in 2026, then the Fed's going to look at that and say, why should we deliver monetary ease if on the other side they're stimulating the economy also? And so they want to see that too. So I think it's a bit about tariffs, but it's also a lot to do with how Congress shapes this tax bill for 2026 and what that means for the outlook for 2026. And the Federal Reserve is signaling greater uncertainty, but they like everybody else just has to wait and see.
All right, so you guys heard it that the Fed is obviously pausing rates. They did mention the balance sheet runoff that we were talking about. They didn't completely pause it. They just dialed it back. So I think 25 billion a month of treasuries they were letting run off, and now they're only going to let 5 billion. So that should help to drop rates a little bit, but it wasn't a complete pause. And so how the market reacts to that, the market might react to it slightly bullishly, but it is not as significant, obviously, as a rate cut. Right now, I'm looking to see where the manipulative move is. And we took out data highs. We did not take out data lows. So I'm looking to see if we can get a trade to get down to data lows. Like I said, we were already in a 4-hour fair value gap on both NQ and ES, right? So I want to see if we could take the trade down to data lows, preferably these equal lows, but I don't know if we get to those today. So I'm trying to see if we close below. We do have divergence on on the 5-minute chart, as long as we don't take out that high,
shift. Less growth, but not recessionary. Less labor strength, but not recessionary. Less inflation progress, paying more attention now than they did, and less easing based on just general notions that they're going to remain pretty aloof because they really don't know what to do, and less QT. And all of those things I discussed with many of my sources long before this statement or the Fed meeting. These were from yesterday or the day before. And the reason I bring them up is that I think when we talk about balance sheet, first of all, that was completely built in. Actually, many expected that we wouldn't just get less QT, that we would actually end QT or do more quantitative easing. So I don't see much movement actually from that headline. But I think that when you look at it all together, what you see is exactly as our panel said, a Fed that doesn't want their fingerprints on the shit because they don't know what the future is, but they've never known what the future is. We just don't know how the globe is going to readjust to all the things that may come down the pipe. Maybe Liberation Day on April 2nd, we get no tariffs. But at the end of the day, keep two things in mind. Okay? That is, if the Fed doesn't do as much, short end is going to get sticky, and it has. Right now, twos are hovering right around unchanged. Matter of fact, most of the curves around unchanged. And the long end is going to be very disturbed that we're not going to get anywhere closer to the 2% target. And most likely, this administration isn't going to make huge progress on deficits. So if you had to summarize, once again, I think you're going to look for some curve steepening driven by long rates going higher.
Rick, when you say curve steepening, I remember those debates that we had about flattening being a bad thing. So is this moving in a more constructive direction here?
Well, I think it's a more constructive adjustment, in my opinion, because I think long rates divorcing themselves from some of the manipulative forces and being more susceptible to market forces is truly a good thing. And once again, I think that the equity markets now are showing you the true direction. Maybe there's not going to be any Fed put, so to speak, but don't kid yourself.
Yeah, this might be a short here coming up. So you see that NQ took out that fair value gap. ES didn't get there. So ES, that fair value gap is right here. So that would be potential divergence there. And if we then close below this, we'll get more of a drop. Someone asked me what data lows are. This is the 2 p.m. candle when the Fed rate came out. The low of 2 p.m. is right there. So I want to see if we take out that low before Powell starts talking. But I want to see us close below this. Powell's going to start talking in 10 minutes. So would love to see an initial move before he starts talking. But yeah, the divergence here in the short term is when NQ took that daily fair value gap, but ES didn't. That created the divergence. Nice move. We don't want to bounce up from here. I want to see it close below that. So Jerome comes on in about 8 minutes here. March 21st. What? I hope we don't just chop around until he talks. But yeah, I mean, there is now a 5-minute fair value gap here that we could bounce off of. I would really like that divergence to remain up here where ES does not take out that daily fair value gap. But Robert, appreciate your donation, man. Thank you so much. Yeah, Robert always donates when he's on. Thank you so much.
All right, welcome back to Power Lunch. We are just about 5 minutes away from the Federal Reserve's press conference. Jay Powell could start earlier, could start later. You never know. Federal Reserve making no change in interest rates, mildly maybe ticking up its inflation forecast. still sees 2 Federal Reserve rate cuts ahead. Here's how markets look ahead of the press conference. I know it's been a rough start to the year, but last couple of days, not terrible. Dow Industrials up 229 points. It's about half of 1%. Kelly, I think the big story as always is technology. The last few weeks, the story has been technology continues to drop. I know Microsoft has been, but right now the NASDAQ catching a nice bid up 194 or 1.11%.
And we don't often see really positive reactions to the Fed, but we're seeing that so far. Let's bring in Freedom Capital Markets Chief Global Strategist Jay Woods. Jay, the chase is on. I don't want to overplay it, but you think the chair is going to spoil the atmosphere here when he starts to talk, or reinforce it?
He's going to add some volatility to this market. Let's see what he says. You know, the one thing that struck me was the unemployment data. They didn't look at that as changing much. Growth went down. So there are going to be a lot of questions. And, you know, usually the first move is the wrong move, and the press conference gets volatile. Watch the last 30 minutes of the day for the true direction of what this market thinks of his comments.
And that said, bond markets, bond yields, whatever you want to say, started moving. But do you think that's because of what's happening with the balance sheet, or do you think that's just the fact that they said, yeah, core inflation is going to go up a little bit this year, but we would still be cutting rates?
Yeah, I think it has more to do with the latter than the former, but both do play an impact. The bonds didn't move much. Let's see what happens when he starts talking. The bond market has kind of had us scratching our heads for quite some time.
Thank you.
As Brian mentioned earlier, you know, mortgage rates go up when we cut 50 basis points, and people are expecting mortgage rates to come down. So it's going to be an interesting press conference. The dot plot to me was key, that there's still at 2 cuts till the end of the year. When they start, well, maybe we'll get a better idea after he talks.
But just for me, and I think you would agree with this, Jay, and I want all of our viewers and listeners, I know there's a lot of people that are kind of newish to the market because the markets have had such a big run the last couple of years. Crypto's brought some people in, maybe some new. By the way, welcome to everybody who may or may not be new out there. The Federal Reserve reserves the right to change its mind based on any data point at any time.
Yep. And you never know what's going to come down the pipe. You know, no one predicted COVID. Look how they had to change to that. I don't want to see them cutting rates because of some unforeseen problem. I want to see them cutting rates for the right reasons, and that would be inflation's under control. The dual mandate has been met. So right now, it seems like things are okay. We still have that tariff uncertainty. The market doesn't like uncertainty, and that's why we've been volatile these last few weeks.
But, Jay, you said something smart. I wrote a piece on Friday about how bad the consumer sentiment report was, and you were like, yeah, bring it on. When it gets this bad, it can't get a whole lot worse. And we saw at least a couple-day kind of fulcrum in markets where all of a sudden, I'm wondering if you're right. Do you think the bad news is priced in here and the economy will actually be stable? I don't mean to ask you as an economist, but how are you positioning as a trader?
Well, I'll tell you as a technician, it's a contrary indicator. When you see sentiment reach historical lows like we did, lowest level since September 2020.
Do you trade gold? Yeah, I was just scalping gold right there. That little move was on gold. You're going to see this haywire price action until Jerome starts talking. So right now, see, this is what I wanted before he fucking started talking, bro. This is the move in the indices that I wanted like 15 minutes ago. Because now any move you try to make, you're going to get seek and destroyed like this.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. Coming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia. When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations. And people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example. Then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5 years or the 5-year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms. Can you say that today, that we have that price stability, that households and businesses are ignoring price growth when you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation?
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the They wrote down, meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3. And so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation.
Sorry. I was saying that it's awkward on days where you have gold and the dollar having similar percentage day moves. But gold took out yesterday's high, and I wonder if after this tanking here on the dollar, if we see kind of a short-term bottom, because if it does and gold and the dollar starts to rally, that might give us a short-term short on gold. The indices really bullish here, which is great for our long. Someone asked if they should buy NVIDIA now. In my opinion, I think you missed the really optimal buy at around 105. But, I have no idea who you are and what your time horizon looks like. So I don't know what you should do. I'm not your portfolio manager. But if you like the company, think of why you want to invest in it. Bond yields are moving down because of that balance sheet runoff that we talked about. So we're getting a nice move down in yield, which is giving, if you have TLT or some other sort of bond position, it's really rallying that. All right, I want to see if there's a short position on gold. To get down to at least that low right there. But we also need a short-term pause in this drop on the dollar. We need the dollar to want to rally here. Oh, what a drop. I hope it doesn't spring back up. We did take yesterday's high, so we do have buy-side liquidity, although it is tough to trade at all-time highs. But I want to see at least that low at 3,046 get taken. With that 5-minute fair value gap, I don't know that we get that type of continuation, but let's see. I love that rates are coming down. If rates can come down without the market taking a hit, that'll be ultra bullish. Yeah, I don't know that gold can get continuation, easy continuation here. Right now, I don't see a move on the indices. We obviously have longs from previous buys that are doing well now. As I said in my videos, I do expect the market to go up in the short term. Yeah, the dollar can't catch a break here. Probably because rates are going down. Ay, ay, ay. Juan, appreciate your donation, bro. Thank you. Why doesn't it feel like a bear market anymore? If you thought this was a bear market, you should exit the market. We were not in a bear market, dude. Shouldn't it be dropping since markets are ripping? Dude looks sad. What, you want me to be smiling ear to ear while I'm trying to find trades? What would be your first TP on the NVIDIA calls? Well, I put in here. Where was it? What did I have? 128. So where the 200 moving average was, obviously you're probably up a lot, so it's going to be hard to get there. I mean, not hard to get there. You're going to have to decide whether you want to take profits or not, but I think in that box would be the first take profit. Yeah, I mean, aside from our swing trades and our buys on Tesla, Nvidia, Google, etc. In terms of day trades, we're not getting a ton of volatility here. It's just in one direction. We're going to have to wait until he's done talking for that. I don't know what extreme bear sentiment means. What are you referring to? Like, what metric are you referring to? For day trades, I don't use moving averages. So I don't know what's better. Check USD JPY? No, I don't trade Forex, dude. That's the wrong channel. Good day for SoFi? No, everything is up, not just SoFi.
This is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation.
I'm not bearish on the SPY and QQQ. I said that we will likely get a relief rally through the end of March and then potentially put in a new low. So this right here is the relief rally. This is what I'm talking about, right? Off of the correction level. As I said, in 2018 and 2022, these relief rallies lasted a couple weeks. So, I think everyone wants things to happen immediately. They want it to go up immediately or down immediately, and that's just not the case. If you look back at previous relief rallies, right? Like here's 2022. These relief rallies last a long time. It's not something that happens in one day. Same as 2018, right? This is 2018. This jump here, this lasted what, a month? February. Yeah. So this lasted 4 weeks. So it's not something that's gonna happen in one day. Do you use Ichimoku to trade futures? No, Ark, appreciate your donation. Thank you so much, man. And thank you to the anonymous person that donated. All right, let's see if we can catch a trade here. Can you show us a sample trade in TradingView? No, dude. You want me to just throw money at a trade just to show you how to execute a trade? The hell? Jay, appreciate it, man. At least somebody was listening. This guy's like, can you just like take a trade and show me something? If you want to learn how to trade in TradingView, you can Google it. This is not volatile yet. No, this is just straight up, which is great if you were long, if you had swings or buys or whatever. But yeah, I mean, in my morning briefing, that's what I wrote here. I said, the Fed may pause their quantitative tightening policy, blah, blah, blah. They will not cut rates today, but will definitely be listening for any updates on their balance sheet policy. If they pause QT, it's temporarily back to easy money and more liquidity. This could give us more upside continuation. Right? So I wrote that at 9 this morning. But yeah, I have all of our buys here, which obviously are doing really well. I don't think that this is going to be the absolute bottom for 2025. I think things will be shaky, but we are due a relief rally bounce and a continuation to get to at least in this area between the 200 and the 100-day. Do you think there's a possibility tomorrow price drop all the way back? No, impossible. What kind of questions are these, bro? Dun dun dun. Any? Yeah, if we get a super high number in unemployment, sure. Really, I think the opposite, though. If we get a super low number in unemployment, then that will mean that the Fed is not going to cut. So, yeah, but I am very happy that rates are falling for sure. Did Jerome kill JFK? No. You don't want to hear my opinion on that. If you want to see someone get canceled, you don't want to hear my opinion on that. Are the green bars good? What does today's news mean for TLT? Well, did you pull up TLT? Green, because yields are down. Oh my God. I want to hear your opinion on that. You don't. I mean, you might want to, but I'm not uncancelable. I mean, in a sense, I am, I guess. Unless they take my Thinkorswim account. Then I'm cancelable for sure. If they take my Schwab account, what am I going to do? What is your thoughts on cover calls today? Yes, I think cover calls are great today, especially on Tesla. Man, there's just no day trade here. I'm taking the short. I feel like gold is going to rug pull. Who else trades off of their feelings? All right, what did we hit here? Did ES hit that high? Oh, we have nice SMT here. ES hit this high and NQ didn't. Dun, 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 dun. I want to see if I could take a risky frisky here. Oh yeah, we have big time SMT here. We have big time SMT here. But no setup. It is definitely risky. It's a 16-point stop. Oh, actually, the stop should be here. Let me see something. I might take a stab. Do I really want to do? I mean, it's only because of the high time frame SMT, but All right, it's up 400. Move stop to break even. 450, 520. Shit, I shouldn't be in this trade. I'm going to take 600 right there. Fuck that. I'm going to take 600 right there. That's how you scalp that shit. Holy shit. That's how you scalp that. Oh my God, bro. Oh my God, that's how you scalp that. See, this is why I say you got to be very careful if you don't know what you're doing. All right. We can call this a pretty successful day here. We can call this a pretty successful day right there. Holy shit. I want to see if we can get another trade here. But I want this motherfucker to stop talking. Because when he stops talking, that's when we'll see the big move.
Than that and different than it does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment.
Ooh. All right, that was exciting. Do you mostly trade futures? For day trading, yes. For swing trading, options. Hell yeah. All right. Let's see if we can take a trade on gold here. Did this idiot stop talking?
Today, live from Post 9 at the New York Stock Exchange.
Yes, he stopped talking. So let's see if we get a counter move here. You only look for entry on the 1 minute? No, that was actually off the 2 minute. I think we can get a move here. If you're still in the short, you're doing fucking amazing. Let's see if we rally off this 5 minute real quick. I might take another short here. Just to get back to data lows. Let's see if I can get this. Are you saying data lows or theta lows? Neither. I'm saying beta lows. What the fuck is theta lows? How many of you guys took a short? That's what I want to know. Hell yeah. I just want to get a re-entry. I think we get to those 2 p.m. lows there by end of day, which there's 40 minutes. Stopped out? How the hell were you stopped out? The thing didn't even go up. Stopped out in profit? Oh, good. What the fuck is going on here? Made a bag. Hell yeah. Oh man, we're now in the 15-minute. Can we get something more optimal, guys? Come on, let me back in. Ah, man. if we get a short stop. I think there's a short on gold here. Off of the 5 minutes. Como este. 3,054.7. I'm surprised no one asked me, why is the market tanking? Time to buy bear? What in God's name is bear? Yes, buy a bear. Go to Dagestan and ask for the Nurmagomedov family, and they'll sell you a bear. This motherfucker. Is it time to buy a bear? People don't even know what they just want to buy something. Puts, calls, bears, lemurs. Just need to buy something. The market's moving. I need to buy something. If I could buy a bear, I would buy a red panda. Those things are so dope. And then I go to the San Diego Zoo and ask if they can keep it safe for me. I'll go visit it from time to time. Okay. Okay, man. Come on. Come to me. I'm gonna go short gold soon. Fine, I'll take it here. $3,057. What was my entry? 53.9. We already made a killing earlier. So I'm de-risking this and just taking one contracto. And we'll see how it plays out. But I think we can get a 2-to-1 off this. Just need to see a little bit of contrarian strength in the dollar. But I want to see at least 600 out of this. Oh, actually, no, sorry. More than that. 780. And my stop is right there. 3,057.8. So first trade was on NQ. Made between 600 and change and 1,200 and change across 10 accounts. So we're keeping this trade small here. Because I typically won't take a trade this time of day. It is 3:33 after all. The market closes in 27 minutes. So I always adjust my risk according to my rules. So my rules is I don't typically trade during this time. So with that said, uh, 3,058.1. Wait, what's my stop? Oh yeah, I should move that. 3,058.1. That's my stop. I bet you we take those 2 p.m. lows after market on ES and NQ. But yeah, I mean, we are at the all-time highs on gold. So we don't really have a reference point besides what's going on now. Another reason why I just took it with one contract. Other than that, in terms of what I think on a multi-day basis, as I said in my videos, and I'll do another update today, but I think, you know, this gives us a short-term rally. We just filled the volume imbalance gap here. Every other time this has happened in this entire drop, we've rejected from there and gone down, right? But based on the Fed saying that they're going to cut back on quantitative tightening as long as we don't get renewed hawkish talk from the White House and or the Treasury. I think we could chop around, go up, go down, but could chop around upside wise for a couple of weeks. Seasonal wise, the last 2 weeks of March are really good in the market historically. And we do have options expiration this Friday where a lot of volatility is going to exit the market and give us potentially more room to get up. I personally don't think we get back to all-time highs that quickly. The average correction lasts 115 days. So, you know, I do think we could chop around in here for a while. We already have a good set of buys on blue chip stocks that we bought, you know, over the course of the last 2 weeks, I would say. So really happy with those, as right now the portfolios obviously look insanely good today. Yeah, I mean, the portfolio's up a good 5 figures today. Who, you know, in terms of how long will that last? I don't think this is the absolute bottom. So obviously on the long-term portfolio, this isn't the conclusive profit, right? They are long-term at the end of the day. But you know, this is very typical behavior. This is what I expected. 10% correction, relief rally, put in a new low until the White House stops their war on yields. I really do like that the 10-year is going down. I think that is really good here. Typically, the measures that would be required to bring the 10-year down are measures that would also tank the stock market. But in this case, the Fed did help us out a bit. So even on X, right, this is what I had tweeted out today. I said pausing quantitative tightening would basically mean quantitative easing, easy money. Depending on the extent and duration of QE policy, it could provide the market with temporary juice to go up, right, to rocket up. Powell won't be cutting rates in today's FOMC. All ears will be tuned to the Fed's balance sheet policy. So, yeah, I think that is bullish for the markets in the short term. And you can see this head and shoulders that I drew out on the 10-year yield. Hopefully the 10-year yield finally gets below 4, right? So, yeah. All right, we're nearing the end of the day. Made a nice bag on NQ. Still have this one contract trade open on gold where my stop is right there. So looks like, all intents and purposes, closing above that fair value gap. This will likely get stopped out, I will say, which is fine. I don't typically trade during this time, and I kept it one contract on purpose. So you're going to get stopped, not gonna lie. Wow, bro. Do they call you Einstein in your family or Nostradamus? It's got to be one of those two. Does it come with a fortune cookie like dude says, where's my car? All right. Well, we didn't get any questions here. So yeah, I will be doing a video just kind of updating my thoughts, but you basically have it there. Are you Canadian? Me? No. Why do I think that it's going to go down to the 2 p.m. low? Because it is. After hours, you'll see it go down here. Could happen in Asia, London tomorrow. But yeah, you will see that. How often do you go live? Every day. Not on YouTube, God forbid. But on the Discord. AMD, did it break out? I don't think it broke out. It's popping out. It did that before. Yeah, I wouldn't trust AMD here. I wouldn't trust AMD until we get a break and retest scenario. So I would want it to break above this level and get a retest. TMF and DCA range. If you're trying to dollar cost average a leverage ETF, you probably should not. You sound bear Canadian. What is bear Canadian? Are you the brother of a magician? Like David Blaine? This is who some people say I look like. Not gonna lie. If I saw him, like if I had a long lost brother and I saw this guy in the street, yeah, I might be like, bro, are we related? So I'm honest. Sometimes you guys tell me I look like people who I don't look like. And it's kind of funny, but the two that I get the most the two that I get the most are Matt Barnes and David Blaine. And I'm not going to lie, I kind of see it. Like if I had a stoner brother, yeah, he might look like Matt Barnes. I kind of see it, but there are some people that say, which is one I don't see. Oh, some people tell me this motherfucker. Billy Joel, I don't see it. I really don't see it. We're not even the same race. I mean, I guess when he was young, he kind of looked Sicilian. So maybe. But I don't see it. I definitely see David Blaine. And then one person told me, which me and my girl laugh at all the time. This was the funniest one. Somebody said that this guy looks like my dad from the South. I don't know if you guys know who G. Hughes is. Let me see if I can make this bigger. But G. Hughes is the gangster that makes this sauce. And someone said that this guy looks like my dad because he looks sleepy and I look sleepy. And I'm like, I don't see it. And then one time my girl sends me a text of this claiming that she sees it, but I think she's just kidding with me. I might close this out early. We got 13 minutes until the market closes. What? Louisiana Creole? I think G. Hughes is probably from that same area. I mean, he's not Creole. He's just straight up black, but... Am I South Asian? Are you blind? What? Prasad. Oh, no wonder why you're asking me. Of course, Prasad would ask me if I'm South Asian. Prasad, if you don't wear glasses, ask your uncle, who I'm sure you have an uncle who's an optometrist. If your name is Prasad, ask your uncle for glasses. He just said Sicilian. I didn't say I'm Sicilian. I said I could see how Billy Joel because he looks like just a straight up old white dude now. But I'm saying when he was young, I could see how he can have like a Sicilian look, and that would be close to how I look. I didn't say I was Sicilian. Gold price is just dead here. I just ended up closing it. No, I'm not taking another trade in gold here. There's 10 minutes left, guys. Like, the money has been made. Just give it up. Or I'm going to give it. Obviously, you do what you want. Is Tesla a buy today? Bro, Tesla was trading at 217. You wait for a $20 per share increase. If it wasn't a buy for you at 217, why would it be a buy today? Do you live stream every day in your group? Yes. Definitely Middle Eastern is my guess. Are you Swedish? My God, some of you are blind, bro. How many years trading? 2010 is when I started seriously trading. And I would say it took me a good 5 years. From Guyana? Wow, you guys are getting real specific. No, bro. No more trades in gold. It's gonna move too slow here for anything to happen. But I think NQ and ES get to that level right there. I just think it happens after hours. Assyrian, and the comment right under you says Nigerian. Poof. At this point, I think y'all are projecting. Whatever cultures y'all are from. There are no more trades, bro. Market's going to close in 10 minutes. But my thesis is that we get there. I already gave you my market analysis, what I think is going to happen in the next couple of weeks. I think we have more of some follow-through days, a little bit of choppiness. I don't think it's going to be as straightforward as a V-shaped correction up. But yeah, just if all you do is just buy good companies when they're depreciated at depleted values, in about a year's time, you will thank me. Because in about a year's time, when all this shit's over, the whole volatility, the trade war, the tariffs, all this bullshit, the portfolio will be printing every day. What is the indicator that tells you we will revisit 2P? My mind. That's just the 2 p.m. candle. So that's called the data candle. Right? Right there. That's when the FOMC rate decision came out. Who thinks stocks will keep going up tomorrow? Nobody can tell you what's going to happen tomorrow, but I think, yeah, we will gradually keep inching up for most of March. Starting out my trading journey, any tips on scalping? Yeah, Google the shit out of whatever it is you want to learn. You're not going to learn from a comment. Google and study for hundreds of hours. Why is TLT heading higher? Because rates are down. So you think we will go back to data low based on feeling? No, idiot. Some guy was asking me about an indicator, and I said it's not based on an indicator. It's based on my assessment. It's not a feeling. It's just that data lows and highs get swept because that's where liquidity is sitting. All right. Well, let's play some ball. I was playing in Central Park yesterday. Are you in New York? West 4th? West 4th? 4th and what? What's a cross street? Fourth and 6th? What are you, by the university? You're like in West Village? Washington Square Park? All right, bro. If you're in the Discord, hit me up and off topic. If there's a game, I'll come. If there's a game going, I'll come. I'll be honest, like the Central Park game was really funny. It was a good run, but I would say the skill level was all over the place. But I haven't played outdoor in a very long time. So it was a good pace. But it was funny. Yeah, if you guys are on the Discord, hit me up. I'll roll to a game. The cage is always full of ballers. Never know who you'll meet. Bro, I ain't interested in meeting nobody. Yeah, maybe when I was 15, I would be excited if like Tracy McGrady or Kobe or someone showed up. You think at this age I would be excited if an NBA player showed up to a court? Hell no. I'd walk to the other court. You think I'm trying to you think I'm trying to play with an NBA player? When I was young and dumb and full of delusions, yeah, I'd be like, hell yeah, bro, let's play one-on-one. You think I'm trying to do that now? NBA players pull up. That is my point. 15-year-old me would be excited. I'm 44, bro. No, that shit will not excite me. I'm walking to the other court. If Matt Barnes shows up, it'll be like the Spider-Man meme. You'd be excited if Jim Cramer showed up? I saw Jim Cramer at the stock exchange. I think back in November when I was here. I was invited to the stock exchange, and CNBC has a whole ass desk out there. So I saw him. It was bad energy. It was like meeting a fucking demon. That's what it was like. Top 3 trading books. You really only need one. Best Loser Wins. For extra credit, you can read Mental Game of Trading, but it's not as good as Best Loser Wins. All right, guys. Glad we got a win. Like I said, gold's going to move like molasses. You have 4 straight bars that are just staying still, so I exited that. One contract for, I don't know, it was like minus 200 or something. But got a big win on NQ. For those of you in the Discord, I'll catch you on the live stream tomorrow morning. I know you guys are excited to be back streaming on the Discord as opposed to YouTube. For those that want to join, hit up the link in the description. I go live every single morning at market open. Otherwise, stay tuned for the next video update. But I appreciate you guys. Thank you for making it fun once again. Ravi, your mom thinks I look good for my age, bro. She thinks I look good for my age. That's all that matters, okay? Because she's aging like milk. I'll be honest. And not good milk, like lassi type of milk. But I'll see you guys. I'll see you guys tomorrow. Peace.